well, silver can't go to $150, $200. It would destroy the markets. There is no definitive price floor for silver. Change the entire wisdom of being naked short. I don't think silver is yet traded in Hong Kong.
I mean, look, right now the futures are up again. We're sitting at a 66.25. We still have the spot market higher than the futures market. So we're still in that backwardation. I would certainly at this point rather be long than short, that's for sure.
You know, all the people that know that gold and silver got destroyed probably haven't even realized it's come back yet. You know, look at the central bank buying has been massive this entire first half of the year as prices were getting destroyed.
Yeah.
So the big money,
smart money,
shit out.
Yeah.
The smart money knew what they were doing and knew what to take advantage of, and the open interest is all but decimated right now. So
if there are almost 90,000 contracts up on the Comex in September, will they drive the price down again to protect the shorts? How low will it go? This manipulation sucks.
They also talk about building, again, a new BRICS metals exchange.
They supposedly want to add 2,000 tons of gold. Does Andy have any updates on price floor for silver?
There wasn't really a price floor put in. It was more along the lines of floors for the solar industry. But the charts that I read showed that silver could go as high as $200 and it wouldn't affect the cost of making these. And it's just a few cents per panel, even at $200. And so the theory that, well, silver can't go to $150, $200 or whatever that number is, it would destroy the markets. It's not true. Silver is very inelastic. It's a little bit in a big product. And I think it's a step in the direction. I mean, to me, what it really does is it just signals that really what I took away from it is that he came out by saying we need to be a minerals powerhouse, is that we've made a huge mistake by outsourcing everything for all of these years. And silver is a critical mineral. He is putting protection under the solar panel industry. There is no definitive price floor for silver, but my guess is that
we certainly know there's no ceiling either.
Yeah,
that's for sure.
I mean, my guess is that it really won't matter, as it's just becoming harder and harder to source at the institutional level. And I think there'll become a race to do so, especially as we see maybe real price discovery, as we start to see pricing slowly start to get priced in other parts of the world.
Silver reaching $200 may sound extreme, but the surprise is how little it could change solar costs. Andy Schectman notes the measures protecting solar do not establish a price floor, yet they expose silver's strategic importance. If demand stays insensitive to price while institutional supply tightens, higher prices may ration availability rather than destroy demand. For investors, physical scarcity could matter more. Next, Andy Schectman exposes why global price discovery could make Western shorts dangerous.
In other currencies, even that will start to maybe change the entire wisdom of being naked short. I don't think silver is yet traded in Hong Kong. Maybe it is. I could be wrong, but I know gold is. And if you have the ability, which there is, to do an exchange for physical to Hong Kong, BRICS, which is a Comex, you can deliver it there. You'd be out of your mind to be a bank who would short it in the West when there's real price discovery in yuan, same day settlement, that can do exchange for physical. This is how real price discovery will slowly move away from suppression of futures market to same day delivery, and maybe we'll begin to see what that real price is and really why the big money has been trying to stand for delivery and corner it for a while now. I think silver has a long way to run. I really do believe that, and it looks like we're right at breaking through. It came up above the cup and handle, came down and tested it, and this is a breakout.
Yeah, no doubt.
So this technically, it's a big deal, and to see it up right now, in the aftermarket.
We're trading up
dollars and something up.
60. I mean, look, right now the futures are up again. We're sitting at a 66.25. We still have the spot market higher than the futures market, so we're still in that backwardation, which is a good point that you brought up some of the technical stuff, because the next question actually is from one of my clients. Hey, Terry. By the way, Terry is begging for you to have a symposium where he lives.
Where's that?
Hawaii.
I have a lot of clients in Hawaii that could have fun.
We should, yeah, we should. And
Silver's next signal may not come from a chart. It could come from where physical metal settles. According to Andy Schectman, Hong Kong-linked delivery, same-day settlement, and backwardation could shift price discovery away from Western futures markets. The hot question is what happens when buyers transact elsewhere at prices disconnected from contracts. For investors, futures pricing may stop reflecting scarcity. Next, Andy Schectman unravels how that pricing divide could expose the market's hidden fault line.
you know what else is really good there?
Golf.
A lot of good
Yeah,
golf there.
pretty girls.
Yeah. I don't know who's looking.
My wife's sleeping.
Yeah, I know. I'm looking. All right. So Terry actually bought GLD call options, strike price 400, expiration December 18th, 26. SLV options, 60 strikes, same expiration. Do you see these trends continuing through Christmas or Hanukkah? Shaloha from Hawaii. So Terry, number one, you probably bought these completely out of the money, which is great. You probably didn't pay a whole lot for them. You're doing great. I mean, right now we're sitting
way up right
Oh
now.
yeah, he bought 400s. I mean, right now gold's sitting at spot around the 400 level, 4,400 level, a little bit higher. Your SLV is kind of right there, if I'm not mistaken, at 59 and change. Aftermarket, it's actually trading up a little bit. So, I mean, look, I would, if you can, again, options, as you know, very risky.
It's crazy. That's at 59 and spots at basically 66.
Correct.
It shows you what happens, the disparity over time.
Correct.
The fund is able to take all of the fees out of the underlying pool of metal, and it creates this inequity. It's supposed to be
It's 10%, right? But it's over 10% actually. But I actually think that you hold on to it. I think it's a great trade. I think you should try and keep it as long as you can. Maybe peel some off as you see profits. That's always what I do. There's no loss in profits. But I mean, right now, like Andy said, technically things look great. I mean, really, we have broken out, and I think that this might be the beginning of the next leg up. It's kind of too early to call that 100%, but I would certainly at this point rather be long than short. That's for sure.
Yeah, all the people that know that gold and silver got destroyed probably haven't even realized it's come back yet. And, look at the central bank buying has been massive this entire first half of the year as prices were getting destroyed.
Yep.
So the big money,
Smart money.
shit out.
Yeah.
The smart money knew what they were doing and knew what to take advantage of. And
The real risk in precious metals options may be believing the rebound is already obvious. What Andy Schectman is highlighting is the widening gap between spot prices and ETF values, while central bank buying continued during the earlier sell-off. That combination suggests institutional demand may have been accumulating while retail attention remained focused elsewhere. For leveraged investors, a technical breakout can amplify gains but also magnify timing mistakes. Next, Andy Schectman exposes why the quiet central bank accumulation matters more than the headline rally.
the open interest is all but decimated right now. So, you don't have much in the way of speculation out there. So I do think that you could make a strong argument. Quietly, this momentum is building and without much fanfare either. You're starting to see a little bit of uptick in open interest, but not very much. So the public at large ain't part of this, nor is the crazy speculators that drove it up into January. This is being driven by the central banks right now, mostly.
I feel like you could be a little bit of a swami right now.
Why's that?
Because every time you talk about something, it's now leading to the next question that's up there from.
I can't see it.
That's what I'm saying. I know you can't see. Without these, you're basically blind as a bat like I am. But the next one is from Thomas. I'm going to not get this correct, but it's Thomas Porgozelski.
Good try.
I apologize if I mispronounce it. 42.99. If there are almost 90,000 contracts up on the Comex in September, will they drive the price down again to protect the shorts? How low will it go? This manipulation sucks.
Who knows? They have an amazing way of working that open interest down to manageable levels as it gets closer to expiration, and maybe through cash incentivizing settlement.
Yep.
That is one of these days, that's always the theory, but it's hard to even envision that when you realize the banks own the exchanges. unless maybe they caught the traders on the, they had all the commercials long, and they caught some traders short, or I don't know. Look, all manipulations end bad, and over time, the physical demand coming from a good portion of the world that is now educated, motivated, sophisticated, coordinated, wealthy, and building settlement systems in other currencies for same day settlement and gaining traction and legitimacy into a network of massive vaulting network and exchanges.
Nearly 90,000 September Comex contracts sounds like overwhelming pressure, but open interest alone cannot tell you who is trapped. Andy Schectman's argument suggests the bigger shift is the declining role of speculative leverage as physical buyers build alternative settlement networks. If paper positioning loses influence while real metal demand persists, repeated attempts to suppress prices become harder to sustain. That matters because investors could mistake engineered volatility for genuine weakness. Next, Andy Schectman unravels why September positioning may reveal who actually controls the next move.
So far, all of them in dollars, but not Hong Kong. You look at United Arab Emirates, you look at Singapore, their same-day settlement in dollars, but the same-day settlement and the ability to settle in digital yuan or in yuan is I think becoming very appealing to a good portion of the world that doesn't trust the way commodities have been priced in the West for a long time. And so this isn't about it happening, this blow up all at once, but every single exchange, every single settlement exchange, every single vaulting system, all the payment rails, they're being set up to challenge the commodity complex. And BRICS just reaffirmed their grain exchange, that they're gonna run their grain exchange. They just came out and said, yes, this is going to be one of the big topics in their next meeting in India. And I talk about the statement that one of Putin's advisors who's helping with this said, we consume as much or more grain as they do in the West. We can't control the pricing. That's done in Chicago on the Board of Trade. But this will change things with the development of this new exchange. Well, the same thing is true. They understand that. The same thing is true with metals. They also talk about building, again, a new BRICS metals exchange, which, again, all of these exchanges, China just signed a deal with Africa's largest bank to settle in yuan, which is convertible into gold. All of these things are happening and challenging over time. So it will reach a point where you got to be out of your mind and be naked short large amounts on Comex when the ability to shift things to Hong Kong with a contract and stand for delivery at a different price will put you out of business. So I don't know, maybe we're beginning slowly to see an era of truer price discovery.
The bigger threat to Western commodity pricing may be the creation of markets that do not need Western approval. According to Andy Schectman, China, Singapore, Hong Kong, and BRICS are building alternative rails for settlement, vaulting, and price discovery. The overlooked issue is not whether one exchange suddenly replaces Comex, but whether liquidity gradually fragments across competing systems. For investors, that could make familiar benchmarks less representative of physical scarcity. Next, Andy Schectman exposes the monetary architecture forming underneath the metals market.
Not today, but we're getting closer to
Well, today was again, it was a little bit, I think, of maybe the start of something that could be something. You mentioned, of course, China. Asia in general is very rapidly expanding their infrastructure, just in banking, in storage, and settlement. DBS in Singapore now allows for fractional gold backed by as little as 1 gram, which is pretty nuts. And then, as we talked about, I think you talked about quite a bit, was HSBC plan on expanding their storage capacities for, I think it was for the Hong Kong vault for what, was it 200 tons?
I don't know. I know that China
number.
is sending a lot of gold to Hong Kong. They're trying to make it a real legitimate hub for the global South and the Middle East.
Yeah, they supposedly want to add 2,000 tons of gold capacity storage-wise over the next 3 years. That's a big number. That's a big number. Yeah. Asian gold ETFs are seeing record demand. So there's so much going on there that it has to start. Metals have no yield, lost opportunity cost, yada yada. What if yield on UST tips, I bonds, stock market versus inflation? If you believe CPI, which one actually gives positive return minus depreciation?
It's gold and silver.
That's it.
I mean, it's double the 10-year treasury. And over the last 25 years, it's 10x it over the last few. And the yield is irrelevant when you realize that the yield that we are being um, the yield that you get on a treasury right now, what, 4%? But inflation is, by their own standard, is barely below that. And we know it's much higher than that. Gold has averaged 9.9% per year for the last 25 years.
A reported 2,000 tons of new gold storage capacity in Asia is not just infrastructure. It is a statement about where future liquidity could concentrate. What Andy Schectman is highlighting connects vaulting, expansion, Asian ETF demand, and growing settlement networks to a broader challenge for Western markets. If treasuries barely outrun official inflation, nominal yield can conceal real wealth erosion. For savers, the benchmark is purchasing power, not headline income. Next, Andy Schectman reveals why storage capacity may matter more than yield.
I don't think you need a yield on gold when you look at real negative return on bonds right now. When you factor in against inflation and money creation, I'd take my chances with gold and silver. And they're going to lie about inflation. They're going to cap yields. And the market's going to understand that. And they're going to demand higher yields. They're going to be capped. You're going to see inflation because that money has to be created to keep those rates down, to buy those treasuries. It's a vicious cycle. So go back and look at any asset that you own for the last 25 years and measure it in ounces of gold, and you'll see they've depreciated tremendously. Gold has outperformed virtually anything. So you don't have to have yield in this environment. And the funny thing is we're in a period of time where if yields go up too high, it blows everything up. The stock market, the bond market, the real estate market, the pension market, the banks, the insurance companies, they all blow up if rates go too high, as do our funding obligations. So in essence, they're going to continue to inflate, lie about the levels of inflation, cap the yields, and gold and silver should benefit most from that, regardless of a non-interest yielding asset.
So just in response to the question that we just answered, we have another comment that Joshua Shearer says, I've been looking around online for junk silver under spot, and it seems like all the silver providers are selling it at spot now. Nothing is under spot anymore. What happened? That's it. That's the point. It just like that, it happens. Well, not just spot price moves, but premiums move at the same time also.
You know, what's very interesting about what we've seen is that the central banks bought more the first quarter than at any time in history. They lied about it. They said they only bought 16 tons. The World Gold Council flagged it at 244 tons, just a 15 times undershoot, misstatement.
A 15 times gap between reported central bank buying and the World Gold Council estimate deserves more attention than another inflation headline. Andy Schectman's argument suggests that real returns, not nominal yields, determine whether bonds actually preserve purchasing power. If governments must suppress yields while inflation remains persistent, savers absorb the hidden transfer through weaker currency value. That is why silver premiums disappearing below spot matters too. Next, Andy Schectman exposes what central bank accumulation says about their private inflation expectations.
As the public sold into this rally into January. The big money smashed the price down by levering up or raising up margin rates and rebalancing ETFs and creating a windfall of selling, squeezed out all of the leverage and the speculators, and bought more than at any time in history. China importing more silver than at any time in history the first quarter. Central banks buying more than any time in history in the first quarter as the price was destroyed. And that, you look at the amount they've continued to purchase, it's increased every month since then. If I had my glasses on, I would look, but the last few months here, I have some right here, actually. Here, let me tell you real quick. Here's the numbers. So they bought 40,000 ounces of gold in January, 30,000 in February, 160,000 in March, 260,000 in April, 320,000 in May, 80,000 in June, and in July, 640,000 ounces.
Damn.
So as the price has been getting hit and doing nothing,
Stacking it
China,
all up.
Tether, Poland, and all the central banks have been buying. And so again, the big money moves opposite the herd. And that's what I take away from all of this. The price has just been misdirecting the masses. The big money's been using it as a subsidy. And that's the truth. And that's you can't argue that.
I heard a very good presentation on misdirection.
You did?
I did.
Where?
Boca Resort.
Oh, yeah. Thank you. I
Yeah.
appreciate
Good-
that.
good-
But it's
good
true.
presentation.
Misdirection is everywhere, dude. It is.
The strangest signal is not that metals fell. It is that official buyers kept accumulating while prices were under pressure. Andy Schectman's thesis shifts the focus from price action to positioning, with reported purchases rising from 40,000 ounces in January to 640,000 in July. That pattern suggests weakness may have been an opportunity for institutions rather than a warning. Retail investors watching headlines could therefore be reacting to the exact signal professionals exploited.